Financial insider Paul Tudor Jones just gave a dire warning about the United States economy. He said all roads lead to, well, in fact, editor, go ahead and play the clip.
All roads lead to inflation.
I'm going to explain why he is saying all roads lead to inflation and also what I think he is getting wrong about his analysis in 3 simple, fast steps. Step number 1, let's go over this debt doom loop that he's talking about. And we're going to start by looking at a chart going all the way back to 1970 to today's date on the left. We go from 20% up to 140%. This is debt to GDP, the federal government of the United States. So as you can see, back here in 1970, we're right around 40%. And because of the inflation of the 1970s, we actually got that down to call it 25, 30%. But your drunk, insolvent Uncle Sam is going to spend like the drunken sailor he is. So the debt, as you would imagine, goes up and up and up and up. Now I want to highlight this point right here. This is 1989, where the debt to GDP went from, let's just say, 30% up to about 55, 60%. I want you to write that down. 1989. Because in step number 2, we're going to go back to see what Paul Tudor Jones was saying about the debt, call it 30 years ago. More on that in just a moment. But the debt goes up and up and up and up as a percentage of GDP. And oh, by the way, the deficits have gotten worse and worse and worse. And the overall debt is at staggering levels right now, 35 trillion. When, oh, by the way, back in 1989, I know you guys all wrote that down, what was the United States debt? A measly 2.7 trillion, an astronomical number at the time. But today, based on this $35 trillion that we have in debt and climbing, it almost seems cute, almost quaint. But the real problem here that Paul Tudor Jones points out is this debt doom loop. So we start with all this government spending. The spending gets out of control to the point now we're at 120 or so percent debt to GDP. And what happens is all the people buying the debt say, wait a minute, I don't think this is a good deal anymore because I see what's going to happen in the next 5 years, the next 10 years. And this is only going to go one way. That's up. In other words, it's only going to get worse. And they're going to have to issue more and more and more treasuries. And the Federal Reserve is most likely going to have to monetize the debt by buying those treasuries because no one else wants to touch them with a 10-foot pole, which is going to create inflation. So here's how the doom loop works. We got government spending up, 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 up. This creates interest rates going up, which creates more government debt. Why? Because if interest rates on the overall government debt go from, let's say, 1% to 5%, that means likely they're going to have to issue more treasuries to pay the increase in interest rate on the overall debt. Well, if they have to issue more treasuries to do this, then what happens to the debt? It gets even worse. So demand for treasury goes down even farther, which prompts the Fed to step in and start buying all those treasuries because no one else wants them. Well, if the Fed is doing this, then they are quote unquote printing money. Now, this is the mainstream narrative here. This isn't necessarily my opinion, but I'm going over how Paul Tudor Jones sees it, or at least how he explains it. I don't know if he really believes this is true. So the Fed prints all this money, that creates inflation, that makes interest rates go even higher than they otherwise would have been, which makes the debt burden even more extreme for the government, which makes the rates go even higher because that demand for treasuries outside of the Fed continues to fall off. So you just get this spiral where rates continue to go higher and higher and higher along with consumer price inflation. This is why, or one of the reasons, why Paul Tudor Jones says all roads lead to inflation. So what are the solutions he was talking about in this interview with CNBC? Well, it's the usual suspects. Of course, he said we have to raise taxes. That's always their solution, even though no matter what the tax rate is, the amount of tax receipts relative to GDP stays the exact same. Editor, go ahead and throw up a chart, and we can see that no matter what the highest marginal income rate is, the government receives about 18% of GDP in taxes. So this is where I start to get a little, let's say, leery about the authenticity of this interview with Paul Tudor Jones. But he also talks about how the spending needs to go down. And then finally, he mentions negative real rates. So this would take us right back to the 1970s, where you keep the interest rate, or the Fed keeps the interest rates under the rate of inflation. So what would likely happen is you get nominal GDP going up at, let's say, 10%, and then you have the debt, the overall debt, let's say it's increasing by 5%. Well, if you do that over the span of 5 or 10 years, pretty soon that debt to GDP is going to come all the way down to a level that, in Paul Tudor Jones' explanation, is much more digestible by the marketplace, to the point where the Fed wouldn't have to continue to monetize the debt. So what's wrong with this analysis? Do I think that we're going to have deflation or continued disinflation instead of inflation? Not really. I don't know what's going to happen over the next 6 months or year. I think we're likely in a disinflationary phase, but I definitely think that we're going to have another wave of consumer price inflation, if not 2 waves, throughout the rest of the 2020s. Very similar to what we saw with the CPI in the 1940s. But my problem isn't necessarily the conclusion. It's more so the analysis is completely incorrect from a standpoint of this. Whether you have the debt to GDP at 120% or 60% or 220%, like Japan, that misses the point. The debt to GDP is not the problem. The real problem is something we're going to discuss throughout the rest of this video. Step number 2. Now let's go back in time to see what Paul Tudor Jones was saying about interest rates and the national debt in 1989, some 35 years ago. We're going to look at one of my favorite books, Market Wizards. This is an accumulation of interviews with some of the top investors and traders of the 1980s and potentially of all time. And of course, Paul Tudor Jones was one of these traders. So Jack Schwager, the person that did the book and the interviews, asked him about 1987 because Paul Tudor Jones made a ton of money during the crash, Black Monday, in October of 1987. And Paul Tudor Jones starts talking about his views of Reaganomics, more specifically, the debt that was being accumulated by the federal government and what it would lead to. Not in the next 35 years, but in the next 35 months or so. Because remember, Paul Tudor Jones is not a long-term investor. He's a very short to mid-term trader. So getting to the book, Paul Tudor Jones says, I know from studying history that credit eventually kills all great societies. We have essentially taken out our American Express card and said we are going to have a great time. Reagan made sure that the economy would be great during his term in office by borrowing our way to prosperity. In other words, increasing the debt. Paul Tudor Jones says we borrowed against the future, and soon we will have to pay. What is he talking about here? He's talking about that the United States, the Americans, are going to have to pay because interest rates at the long end of the curve, let's use the 10 years of proxy, are going to go higher and higher and higher because of all of this debt. And then sooner or later, it will lead to an inflationary doom loop. Finally, he says, we are going to relearn what financial discipline is all about. The government is going to have to reduce their spending because if they don't, then the long end of the treasury curve, as far as yields, are going to go up and up and up and up to a point where the bond market is going to constrain the government spending. And that's where you're going to get an economic contraction because so much of the economy revolved around government spending to begin with. Literally the exact same argument he has today in 2024. Call it 35 years later. Step number 3. This is what Paul Tudor Jones got wrong. And I want to be very clear. I'm not saying he doesn't understand this stuff because I'm sure he understands it a lot better than I do. But he didn't give it enough weight in his model. Or maybe he's just human and he has a bias because he grew up trading throughout the 1970s, which was an inflationary decade where we saw long end rates go up and up and up. But for whatever reason, I think this is why his model was incorrect. So here we have Paul Tudor Jones himself, obviously. You can tell by my incredible artwork. And he has a balance sheet. Let's just say he's still running a fund. I don't know if he is or just managing his own money. But on the liability side, we've got this guy. We'll call him an investor. Now, it's very key that you notice the sign this investor is holding. It says on, right? So this investor gives Paul Tudor Jones his money, and therefore he's got this asset on his balance sheet. Let's just say it's $100 million, just for easy math. It's going to be way more than that, but let's just assume that it's $100 million. So this investor wants a return on his investment. So Paul Tudor Jones has to go out there and make some decisions. Let's just assume for a moment we've got inflation running at 5%. Well, if bonds, I'm just using that as a proxy for treasuries. I should just put treasuries there. So if treasuries are paying 5%, then this is a bad deal because he's not going to get a real rate of return because the 5% is just going to be eaten by the loss of purchasing power of the dollar these treasuries are denominated in. So this isn't going to be a choice for Paul Tudor Jones if he believes this level of inflation is going to continue into the future. So he's got to look at stocks. Maybe he can get a 10% return there. Or maybe gold and commodities, maybe, or Bitcoin. Maybe he can get a 15+% return there. So this is all predicated, his decision-making process is all predicated upon having to get a return on investment. Okay, we all understand that because within a certain amount of variance, we operate under the exact same conditions, we as retail investors. All right, now let's look at a second scenario. This is a global dealer bank, a global money dealer, sometimes they're called, and they're going to have a balance sheet as well, assets on the left, liabilities on the right. But notice, the money they have to deploy is coming in from not investors, but depositors. And sometimes they're borrowing money from other banks as well. But just for the sake of this example, we'll oversimplify it so you understand the concept. So this depositor doesn't care about a return on his investment. He wants a return of his investment or a return of his deposit. That's why he's depositing it with the bank to begin with. So this bank has a few different options. They can go out there and they can lend this money into the real economy, and create a loan that's represented by this red square. And let's just assume for a moment they can get 5% by lending it out into the economy. But they're going to be taking a substantial amount of risk, especially if this global dealer bank looks at China, looks at Europe, looks at Canada, looks at South Korea, looks at the UK, and they see economic storm clouds on the horizon. They may look at the United States as an anomaly right now, but the probabilities are very high we're going into a global recession. So are they going to want to lend this money out just for an extra, call it 1%? I don't think so. So they're going to have another option. They can go ahead and buy treasuries. Now, they're not going to get the same yield, but they're going to take a lot less risk, and they know for sure that this guy is going to get a return of his investment or of his deposit, because this treasury is denominated in dollars, exactly like the deposit, and at the end of the maturity, you're guaranteed to get, at least in nominal terms, 100% of the principal plus the interest. So it's a completely different decision-making process. Now, just to explain my point even further, I want to go through a quick thought experiment with you. Let's just assume you are running this global dealer bank outside of the United States, and let's just assume for a moment that you can borrow at 1% from your depositor for 2 years. So at the end of the 2 years, that depositor is going to want his or her money back. Let's just say they've got it in a 2-year CD or something like that. All right, well, you can go out and buy 2-year treasuries. So you're matching up the maturity. In other words, you have zero interest rate risk, because even if interest rates go up, you don't care, because all you're doing is pocketing the spread. You're just waiting for this to mature so you can take that money and give it to the depositor after that 2-year time period. Again, you've matched up the maturities. So now let's think this through. If you're paying 1% for those dollars, but the government is paying you 4%, you're pocketing 3%. So my question to you, the viewers right now, is how many treasuries would you buy? Just assume for a moment you could borrow an infinite amount of money at 1% for 2 years. How many 2-year treasuries would you buy? Most of you, 99.9% of you right now, are saying all of them. All of them. Why? Because all you're doing is worrying about a spread. That's it. That's it. Now, what if I were to tell you that the inflation rate in the United States is 5%? You'd say, who cares? Because I just borrowed $5 trillion and I bought $5 trillion worth of treasuries, and I'm going to pocket 3% of $5 trillion. So I could care less if the inflation rate in the United States is 5%, because I am massively increasing my purchasing power by just pocketing the spread. But now let me throw you a quick curveball. What if Janet Yellen comes out tomorrow and issues another $3 trillion in 2-year treasuries that nobody was expecting? And you see, Paul Tudor Jones would say, I told you so. I told you so. You see, the deficits are exploding. The government has to spend. And therefore, Janet Yellen has to issue more supply. And over the short term, let's just assume that interest rates went from 4% up to 5%. Now, how many 2-year treasuries would you buy? You'd buy all of those as well. Because now your spread just went from 3% to 4%. The deal became even more attractive for you. And oh, by the way, the deal would become a lot more attractive to a lot of other entities outside of the United States. And therefore, you would have a bidding war, which would likely take those interest rates right back down to the 4% where they started. Because you're always going to have a little bit of a spread because you've got growth and inflation expectations. And if growth and inflation expectations are increasing, well, then that changes the risk reward to favor the loans instead of the treasuries. So the main takeaway here, as much as I hate to say this, because I detest government spending, more on that in just a moment, the bottom line is, unfortunately, the way the global monetary system is set up, with treasuries being effectively base money outside of the United States in the Eurodollar system, we live in a world where supply of treasuries controls the demand. So if the supply of treasuries goes up, the demand for treasuries also goes up, especially when the curve isn't inverted, when you have a steep yield curve, which is usually what we see. And that just means long-term interest rates are higher than short-term interest rates. Now, for those of you who are a little more sophisticated, I'm massively oversimplifying this. It is true, it'd be tough to match up the maturities, but the banks would do that through hedging, through derivative instruments, such as an interest rate swap. But that's a little too much for this video. Again, I'm just going over the concept. So if it is true that the supply of treasuries controls the demand for treasuries, and this is what was wrong with Paul Tudor Jones's model back in 1989, we can safely assume that he probably hasn't adjusted his model. Now, am I saying this is a free lunch? Therefore, the United States can spend and spend and spend, and the debt to GDP can go to 200%, 300%, 500% without any negative consequences? No, that is not what I'm saying. But the crisis isn't in the treasury market. We don't have a debt crisis. We have a spending crisis. This is what I'm talking about. We've got the government right here, and they are spending money into the real economy. But all of the spending they do, the trillions and trillions of dollars, is misallocating resources. It's creating malinvestment. This is making the economy less efficient, which is lowering the standard of living for all Americans, but especially the poor and middle class. And if you want a perfect example, I would point to 2020, 2021, all the way through today. The government locked you in a cage. They said that you can't produce any more goods and services. And they gave everyone, quote unquote, free money. They destroyed global supply chains. Now, have we gone through a recession yet? Well, not officially. But I want to ask every single one of you right now a question. Is your standard of living today higher or lower than it was in 2019? And if you answered higher, then I can assure you, you are one of the fortunate Americans that own a significant amount of assets. Because for everyone else, it has felt like the 1930s, a Great Depression 2.0. And that's because of the government spending, creating the economic distortions that make the economy less efficient and lower the standard of living, especially for those who don't own assets. You see, this is the problem. Let's use Paul Tudor Jones' example that we discussed in step number 2, where he said basically the government had this Amex card and they were running up the balance on the American Express, and sooner or later we're not going to be able to pay back the credit card or make those payments on the credit card because the interest rates are going to go too high. Is that the problem? As if all we have to do is fix this and maybe drop our payments a little bit to American Express, so then we can spend even more money. See, this doesn't fix the problem. This makes the problem worse. That's why I say the problem is not that we're going to have a debt crisis. The problem is we have an economic crisis from the government spending that created the debt to begin with. So if we want to fix the problem, you don't make it easier to make the payments to American Express. If you want to fix the problem, you've got to reduce what is causing the problem to begin with. And that is your drunk, insolvent Uncle Sam spending as much money as he can to buy your vote. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.